One of the biggest discussion points in the market right now is whether to chase or fade the homebuilder trade. We got some better data this morning showing builder confidence rising for the first time in 4 months. Their 2024 outlook also improved. But names like D.R. Horton, Lennar, Pulte, Taylor Morrison, and Toll already were trading at record highs again on Friday, taking a pause today. The ITB was our mystery chart. That's gained 65% this year. And we've heard a number of bullish sell-side analysts say these companies are still cheap and attractive on historical basis. But my next guest says now is the time to take profits. Joining me is Carter Worth of Worth Charting. Carter, it's good to see you. Welcome. And why the builders? Why do they jump out to you?
Well, I mean, it's just at this point, the sheer angle of the lines, right? For someone who spends a lifetime looking at charts, one could say, so what? They can go higher. But to my eye, we have something that's basically unsustainable. We know the two areas of the market that have moved the most, regional banks and home builders, are very rate sensitive. But note today, with this good news coming out on the fundamental side, what's happening? The stocks are all down. And that's because a great deal has been priced in already. We might have some charts we can look at, but I would just point out the following. Two things. The home builders as a group, since the absolute low in the financial crisis, March 6 of 2009, have almost tripled the performance of the S&P. I mean, that S&P line has Apple in it, and Amazon, and Google. In fact, home builders have paced the QQQ, which is the champions of all time. And so it's long-term excess, but then on a more immediate basis, and you'll see that in the here and now chart, we have a group that from the October 27th low is up 40+% in a period where the market's up 15. So it's a beta trade, and we know that it has done what it might be expected to do in response to the drop in yields. But at some point, a great deal, if not all, of the intermediate potential is priced in, and that's my judgment.
For what it's worth, our last guest, Chris Grisanti, has also exited the rest of his home builder trade. But at the same time, we've got a lot of value players like Bill Smead saying these things, could have a huge tailwind behind them. And the analysts we speak to are saying the valuations aren't that expensive yet. I think a lot of these, like Toll, Carter, might trade, under 10 times earnings. I know it's not, you're not a valuation guy per se, but, you look at some of it and go, okay, maybe there's still value there.
And I think that's all about what one's time frame is, right? If one is looking very long cycle, it's almost always right to hold on to real estate and to land and what have you. But here and now, just deciding whether is this a place to have capital, at least full size, versus reduced capital or hedged capital, my thinking is it's not a place to be as long as one might have been or has been, only by virtue of how much has been priced in already.
All right, but they were showing Toll about 8.5, Horton a little over 10 times. Let's pivot from those to the regional banks, which are getting a lot more fanboys lately. Maybe that's putting it too strongly. A lot of people saying rates are normalizing, the economy holding in there, and it's time to take a look at this beleaguered area of the market.
Yeah, so here, this is a particularly impaired area of the market when we had the sort of the run on the banks in about 6-8 months ago. But regional banks, too, in response to the drop in yields, 5% to under 4 on the 10-year, regional banks have surged. This is a chart, actually, of the KRE, the Spider Regional Bank ETF, which has about 90 names in it, before the drop in yields. If we look at the next slide, you'll see here what's happened since. We have popped all the way back to the level from which the collapse started. And that is the definition of a rally to a difficult level, which is to say there's overhead supply, a lot of dead bodies above, who are interested sellers, having lost a lot of money, are interested in recouping those losses. And so, again, it's all about what your time frame is, but here's an aggregate that in 1 month is up 20%. The S&P is up 4 or 5. It's just a little too hot. It's often right to take the road less traveled, and that's my thinking here.
All right, Carter, final parting word, because I remember talking this time a year ago when both of us were expressing some concern about the market, and it went totally the other way. What do we draw from that? What does that tell us, the S&P broadly speaking?
Yeah, I think it's all about, again, your time frame. To think about on the October low, just October 27th, the Dow was down for the year. The oldest aggregate of all. I mean, this last 6-7 weeks has saved it and has put a lot of edge on the S&P. But it's always that way. It's just a day or two or a week or an intermediate period from being good or quite bad. Just to think October 27, the Dow was down on the year. Was that a good year? No. Now we have this ricochet, and it's all love again. I think you're going to find it's going to be less sanguine when 2024 comes around.